Chris, I'll turn it over to you. You got 30 minutes. Go for it, man.
Well, as Ginny mentioned, I'm going to go through a presentation on Caliber, and then I'm hosting a breakout session. What can you bring into the breakout session? Obviously, questions about us, our fund investing, but also kind of anything you want to discuss. If you've got projects to look at, it's always a good thing to talk about. If you want to talk through, different structures and strategies, but you don't want to be a part of a sales pitch, that's fine too. We can just go through whatever it is that you want to cover. Hopefully we'll make it a good breakout session and create a really dynamic discussion. So with that, let me rock and roll through here. Hopefully you all can read this. Basically, it means what you all know what it means, which is that we try our best. We try to tell you everything we think is going to happen, but of course, nothing in the future is guaranteed. So who's Caliber? What do we do? Why is it interesting? The company is a full service real estate investment company. We're a vertically integrated platform, which basically means that we help you invest into different forms of real estate funds, and Opportunity Zone Fund being one of those. We then go out there and find great deals, invest in those deals, acquire them, finance them, develop them, construct them, and then manage them for hopefully a successful cash flow and a successful exit. The company has about $500 million in current assets under management. And we have about $1.5 billion in what we call assets under development, which means we own land that we're currently developing to build out another $1.5 billion worth of real estate. So we have a pretty good view, not only in what we already own, but also where the dollars are going in the future. And we're constantly running a pretty sophisticated platform to secure new opportunities for you, as well as continue to manage and build the ones we already have. I was thinking through how to structure this conversation to be as successful as possible, considering the fact that you've probably heard quite a bit of information on opportunity zones already. So I thought I'd start with what is the bottom line on the tax benefit for me, potentially, and then how do I achieve that bottom line with Caliber? So first and foremost, on the screen, you've got essentially a comparison of $1 million traditional investment coming from a capital gain and $1 million QOZ investment. On the left-hand side, you can see you have $1 million cap gain. Maybe that came from selling stocks, or maybe it came from selling your business or selling a piece of real estate. And in a traditional investment, you're going to have to pay taxes on that capital gain. So after your first round of taxes, you invest the $720 that's left. After 10 years at an 8% annual growth rate, you're at $1.5 million. You pay another round of taxes when you sell your investment, and you net down to $1.3 million. So you start with $1 million, you net down to $1.3 million. If you use the exact same fact pattern in an opportunity zone investment, because of the way the tax incentive works, you actually net out about $1.9 million, which is 3 times the profit of a traditional investment, with effectively a similar or the same risk, because you're earning the same rate of return. So how do you get this maximized QOZ tax incentive? One, I've got a couple of things for you to consider. One, I think you need to grow the value of the capital, because about 80% of the tax incentive comes from the benefit that shields you from future taxes on the value growth of your investment. So that means you have to be investing in real estate or real estate related investments that actually increase in value substantially over a 10-year period. Investing for cash flow is great, and we certainly do produce cash flow on our investments, but you need to be focused on growth in terms of this particular structure. 2, I think you need to make a lot of bets. If you are out there making a single bet in a single market for 10 years and hoping it works out, there's a lot of risk associated with that. So if you want to maximize your risk-adjusted return, you've got to make a bunch of bets. And if you do that in a multi-asset fund structure like we do, then you can compound your gains within the fund. So say you take a building, you turn it around, you maximize its value, and in 5 years you sell it, double the value of your equity, you can actually do that again. So you can reinvest that compounded gain within a 12-month period. You have some interim tax issues you've got to manage through. But that's how you compound the gains within the fund and generate the best possible rate of return. And then you've got to find a way to maximize your exit. The structure of an opportunity zone fund allows you to wind down the fund and sell assets one at a time, which is always optimal if that's where you're going to get your best price. But we think there's going to be opportunities after the 10-year mark to sell our fund as a portfolio, or to potentially roll it up vis-a-vis an UPREIT into a public security, which is great because if you end up owning shares in a public REIT, you as the investor can then decide, hey, I want to sell my shares today, or maybe I want to stay in for 15 years or 20 years, and I want to get the cash flow on this investment and shield myself from taxes on the upside or the value growth of the investment for a longer period of time. So maximizing your exit strategy should maximize your tax incentive as well. How do you achieve that in the world of real estate? Our thesis is you do it in middle market real estate. And so what we find in this is you've got kind of a U curve, and this U curve, it represents the amount of competition that we face when we're trying to buy assets. So in the institutional market, which is typically investments that are 100 million or more in size on a single asset deal, there's a lot of competition. We're fighting every REIT in the country and every large investor who wants to deploy capital. On the entrepreneurial side of the market, which is typically 5 million or less in size in projects, again, you're fighting a lot of entrepreneurs, a lot of folks who pretty much can hang a shingle tomorrow and start a real estate investment business. And competition is very strong. In the middle market, which we define as $5 to $50 million projects, we find that there's a lot less competition because you have to be both sophisticated enough to deal with the complexity of a $25 million deal and entrepreneurial enough to acquire those types of projects outside of the institutional framework that most of our institutional competitors use. So that is where our opportunity lies. And as you can imagine, that's where Caliber invests. The other piece of it is you've got to invest in great markets. The Opportunity Zone program was great in that it built out these 8,700 census tracts across the country, but which specific census tracts are the best to invest in? We think that those are located in what we call the Southwest and Mountain West regions that we invest in. And we think that those are located in the cities that had really great state level leadership and local leadership to pick census tracts that made sense for development and for growth. So we focus pretty deeply in those areas, kind of conflicting with that story of out-migration. We have a lot of in-migration in almost all of our cities that we invest in. And that's a great driver for growth and value appreciation. And then from a structure standpoint, how is your investment structured? As an investor, typically with Caliber, you're coming in as a limited partner. You're putting your money into a fund, which is structured as a limited partnership. And the partnership itself owns real estate holding companies that then own real estate. So as direct as you possibly can be as an investor owning a partnership interest in the fund owns the real estate. These real estate holding companies are structured as qualified opportunity zone businesses to conform within the law. And then Caliber as the general partner is the decision maker. It's signing on the financing. It's taking risk alongside you. And then it's also delivering services to the real estate to ensure that these projects go from point A to point B successfully. We have a track record of doing this over the last 13 years. And as far as the assets we've sold so far, our investors have realized at a 2.1 net equity multiple or better, which basically means if you put 100,000 in over roughly a 5-year period, you've gotten 210 back. We also have a long track record in the opportunity zone space. We were one of the first funds in the country to open. We've been on the speaker circuit, as probably some of you may know. We're out there kind of building the industry and helping all of our colleagues in the opportunity zone space succeed. We have other opportunity zone investment funds we've collaborated with in the past. And as an example here, we spend a lot of time with state, federal, and local government, touring them through sites, showing them how projects are working, showing them real examples of success for the program to hopefully promote support into the future. A couple of other examples of some projects we've done recently. We just completed a behavioral health hospital conversion. So this was an adaptive reuse project. We acquired a assisted living facility that at the time was boarded up, gutted it, renovated it, brought in a new doctor group as a tenant, and had signed a 20-year lease. On this project, we acquired it for $11 million. We put another roughly $12 million into it, and we're into it for 23. It leases at about $2.4 million a year in net income, which is better than a 10% cap rate on cost. And we think it's worth around $35 million today. Great example of how real estate related investment funds like mine are actually driving business growth as well. We've acquired a large portion of historic downtown Mesa And one of the things that we're doing is we're providing significant lease incentives for business creation. This is a deal that we've done with Launchpad that we're now, I think, heading into construction on. And what it allows us to do is help them open a new co-working location, gives them relocation expenses to open their business, gives them all their tenant improvements, and it's driving the growth of their business into a new location while also being a real estate investment for us. If you join us at Caliber, you're joining a community of over 1,200 investors who've invested over $500 million in equity with us since inception. And the best thing about the Caliber community is we get together, we do it virtually, we do it in person, less in person the last year and a half than virtually, but certainly we'll be back in person soon. And you get to be amongst a group of like-minded individuals who probably have a lot to offer you, not only as a colleague in the investment process, but also as a way to learn about how to invest in private equity real estate. So just digging into the fund quickly here, I wanted to talk about why you would invest in an opportunity zone and fund in general. My thesis is pretty simple. We think that due to COVID, the disruption that's occurred in the real estate markets and in the private real assets is what they call that category, is the greatest disruption we've seen since the 2008 financial crisis, which happened to be the best buying opportunity in modern times for real estate. And so while certain categories of real estate are still hitting all-time highs in terms of their value, there's a lot of disruption in the market, there's a lot of busted developments, and there's a lot of opportunity for us to acquire investments or invest into communities that really need those dollars, but also do it at a basis that makes a lot of sense, that creates tremendous upside for us as investors. And just as a little piece of our history, when we started in the trustee sale auctions. We started buying, foreclosure properties, non-performing notes, bank-owned properties, bankruptcies, et cetera. So while we are a traditional real estate investment and development fund in this particular category, we are applying the distressed real estate investment skill set that we have as we go out and look at future opportunities. In addition, I think you'll find that you're in good company. Preqin estimates that we are basically going to see alternative assets grow from a $10.7 trillion market to a $17 trillion market in the next 5 years. And that's as investors are looking for a place to go with their dollars outside of stocks, bonds, and insurance products. The three things that I think that make a fund successful in this space are the right combination of infrastructure at the fund level, meaning being able to execute at an institutional level, not screw up your tax benefit, manage all the finance, tax reporting, et cetera, that's required, combined with an entrepreneurial deal structure and kind of deal flow infrastructure. So you've got to have a track record investing in these turnaround deals or these new construction projects in the middle market. You have to have regular deal flow coming in because as capital comes into the fund, you've got to place it rather quickly. And you have to have, most importantly, number three, the ability to execute. So that demonstrated ability to source properties, develop properties, and manage assets. That's what you're relying on with us as an investor. You're making a 10+ year commitment to our relationship. It's kind of like going from dating to marriage after the second date. And you're relying on us to be able to go out there and continue to execute on this type of a strategy for you for quite a long time, and probably through several market cycles. Within our fund, just as a quick look, we're targeting a 13% investor or a fund level IRR, essentially, and that translates down to you, depending on when you invest in the fund. We're targeting an equity multiple at the fund level of 2.5 times, which is fairly achievable considering the fact that we're doing real estate development. We obviously want to exceed that number, but that's a good quality target for you to look at. And we're combining opportunistic and value add strategies. So we're both building and doing heavy redevelopment, but we're also doing some value add components to enhance management and enhance profitability of the assets. And in essence, we have a very diversified fund because we're focused on place-based investing, going to the best opportunity zones and the best locations in our region and investing in the projects that make sense for those communities at those times. A small example of some of the things we've done so far, we're building energy efficient townhomes. I just mentioned the behavioral health hospital. We have acquired this large portion of downtown Mesa, which is right next to the Arizona State University new college campus that's being built. We're building a private school expansion at Rancho Solano with a tenant in tow, and we just completed the construction of a DoubleTree Hilton hotel. In addition to that, not only will you know as an investor what you're investing in the fund what we currently own and be diversified across that pool of assets, but you'll also have some visibility to the extent that we can share about what we're acquiring next. And we have two large developments that we're acquiring in one of what I think is one of the best census tracts in the country. One is a mixed-use development doing office R&D. We have tenants in tow to move into those spaces, as well as sort of an innovative residential and entertainment component. And it's a smart city-oriented development, so it's infusing that development with technology around smart cities. And then we have a wellness campus that we're building, all medical within a medical corridor, to try to satisfy a massive increase in demand for medical related real estate projects. And then we're building traditional apartments with market rate apartments with a HUD takeout, which is some of the best, cheapest financing you can acquire. In addition, as an investor with Caliber, you're going to get an impact investment report that we release quarterly in conjunction with NES/JTC. They're helping us on the impact investment rate of return. And you're going to be able to see not only what is your financial IRR, but what is your impact investment rate of return along the way. And then last but not least, on fund structure, the offering is a maximum of $500 million. We have a 1.5% management fee over a 6% preferred return with an 80-20 split for $1 million minimum investment, or a 75-25 split for a $250,000 minimum investment. The fund is audited by Deloitte. Tax counsel is Mr. Mark Schultz, who's an expert/celebrity in the space these days. And we have one of the best teams in the country investing in one of the best regions in the country. So if there's anything else that we can cover, I'm happy to take some questions now, and otherwise we'll hop into it in the breakout session.
Okay, fantastic. We've got time for several questions. I've got another 10 minutes or so before we have to break for lunch, and then we'll get you in your breakout session. We're going to use the same Zoom link that we used for the breakout session earlier. We'll use the same one for Chris's session in a minute, and I'll get that posted in the chat in just a couple minutes here. And then if you want to join Chris in that breakout session, you're free to do so, or you can just kind of hang out in the main session. We'll be on a lunch break. I would encourage you to chat with Chris if you have any questions, though. But let's get to some live Q&A here for a few minutes. Where did my question go here? Here we go. Let's see. Paul asks, and he sent this very early on while you were rifling through your first couple of slides. He says, Chris, where is the deferred tax liability payable in 2026/27?
Here, I'll flip back to this slide here so we can get there. Basically, it comes out in 2027, as you mentioned, in my little model here. It's this guy down here coming out through here. And it's an important thing to notice. Everybody knows that you've got to pay your taxes in April of 2027, but you can't really sell your investment until 4+ years down the road. And so how do you do that? So every fund's handling that differently. Our fund thinks that the best way to do that is through a debt-based distribution. So we're using very little debt on our fund. And in 2025, we will likely do some refinances, pull out some proceeds out of our assets, and distribute those debt proceeds to you as an investor, which would be a tax-free distribution based on the structure of what we're doing. We think it'll be about 20 to 40% of your invested equity, maybe more. And that would allow you to have the cash on hand to pay your taxes as needed. So it actually is interesting because if you deploy $1 million into real estate for the next 5 years, we can grow that value of that real estate pretty significantly to enhance the ability for us to draw some debt against it. And using debt to make that distribution doesn't force us to sell assets in the interim. So I think it's the right strategy. I think a lot of fund managers are doing that. And I think to the extent you're in a multi-asset fund with lots of different assets that are at different stages of their life cycle, you can have probably a higher likelihood that strategy is going to be successful than if you're in a single asset fund that, God forbid, something like COVID happens or something in 2025 or 2026 and you own a hotel. Well, it's like, okay, you're not refinancing that asset anytime soon. And then how are you going to pay your taxes? So the other thing we've done in our fund, since we're mixing residential with more opportunistic asset classes, like a little bit of hospitality and a little bit of, kind of entertainment and things like that, we get the return profile from the really sexy stuff. But on the residential side, we can maximize the debt on those properties because they get the cheapest possible debt, the best possible terms. So we might have an asset with no debt at all and another asset with as much debt as it can handle. And at the fund level, you're still going to see less than 50% loan to value.
Yeah, that's helpful, getting that liquidity out to the investors so they can pay their tax liability April 2027.
Important.
Yeah, several more questions here coming in now. So I'm glad we've got some time for these. Alex asks, and he's referring to one of your earlier slides, to key ingredient number 4 specifically. What do you, Chris, think about non-exit, that is QOF, buy and hold?
So we have a couple of those. As an example, in our fund, we built some energy efficient townhomes that are condo mapped. We're going to hold them as rentals for 10 years, and then we're going to exit vis-a-vis condo sales because we think that maximizes the value of the exit. So we'll certainly do deals where we hold them for 10 years at a time. I think you really have to follow what makes sense in the asset class. And hospitality as an asset class runs in pretty deep cycles, high highs, low lows. And so you want to catch the high and then redeploy that. Other asset classes, may not have as deep of a cycle, but in general, you're going to find that most real estate, once it's bought, developed, stabilized, and then the cash flow is optimized, that's typically the maximum value point to sell. Doesn't mean that holding it for another 5 years is a bad idea. It just means that you're not going to see nearly as much value growth, which if you could sell that and do it again in another 5-year cycle, that's where you're going to really drive more like a 3-4 times equity multiple versus a 2 times equity multiple.
Good. Really timely question from Matt here. It looks like we're getting to him just in time. He says, Chris, could you take an investment today? Today is my 180th day from gain on January 28th. And he provides his email address, which I'll pass along to you. It'll be in the Q&A for you to go find there, Chris.
Yeah, sure. Absolutely. We, the way we designed our fund, which is a little different than most of our competitors, is we are dynamically essentially investing the fund as dollars come in, while we are also consistently acquiring assets. So to give you a little more background on Caliber, we have a non-QOZ real estate development fund that is just a normal development fund. We have a core fund that we're launching soon. We have a private lending fund, and then we have a programmatic syndication strategy. So that means that we're out there buying deals and letting people invest on a project by project basis as well. So because we're so active and we're doing so many projects, every deal runs through a single investment committee. It doesn't matter if it's an opportunity zone project or a non-opportunity zone. The investment committee is out there sourcing and running deals on a regular basis. If it happens to lie in an opportunity zone and it happens to qualify for the program, we push it through that channel. If it's going through a different channel, then we push it through the different channel. So what that all means is we have a really, really active deal pipeline. And if you have dollars coming in, unlike a lot of our competitors where we have to close the fund for new investments until we line up the next deal, and then we open it, and then we close it, and then we open it, and we close it, we can keep our fund open. We can take in capital on a daily basis, and we can match that capital into a QOZ project within 6 months without risking violating the rules of the law. So in essence, that's what we do. That's a little bit more of how the sausage is made at Caliber. And I guess on that note, every deal we do within our Opportunity Zone Fund is a QOZB itself. So if you've already created your own Opportunity Zone Fund that you're personally managing, and you need a place to place your own capital, you can actually co-invest with our fund at the deal level with Caliber. So it doesn't preclude you from investing with us. You just can't invest into our fund. You have to invest in the projects that we invest in.
Fantastic. Good answer there, and helpful for that gentleman as well. And Chris, I believe his email should be appearing for you in the answered section of the Q&A if you want to grab it.
I will send you a note.
Okay. let's see. We got time for a few more questions before we break and get that breakout session open. I'm going to post the link to the breakout session right now. Nobody's going to be in there for a few more minutes till we wrap up here, but there's the link in the chat for the breakout session we're going to have with Chris when we close down here for lunch. We got several more questions I want to get to right now, though. First, Chris, we got some more time.
Yeah, I try to make this presentation quick so we can spend more time on questions, because I think questions are probably more valuable for everyone to get answered than what our canned discussion. So
agreed. No, this is helpful. We got plenty of them coming in, so this is great. John asks, Chris, can you pay out cash flow from profits before the 5-year hold, and if so, how are those payouts treated for taxes?
Yeah, so I'm not your CPA. Consult your CPA. You've had the disclaimer, but I used to be an accountant with PwC, so I have a little bit of background in that world. Bottom line is the capital gains and the value growth of your investment is what's protected from taxes as long as you hold for 10 years. What I distribute out to you in current income vis-a-vis rents is going to be taxed as ordinary income, theoretically. And it's going to be passive. So if you have passive losses that might offset your passive gains, maybe that would be a good tax strategy for you. And we happen to have funds that produce those. So you theoretically, if you're getting income distributions out of your opportunity zone fund, you're going to be paying taxes on that. Now, normally when you make a real estate investment, there's a depreciation shield that comes with that, where you make $1 million investment and we're depreciating your $1 million over a period of time. So you might be getting distributions, but you're paying no taxes on those distributions for a while. When you make an investment into an opportunity zone fund, you're coming in with no basis. So we have to produce basis for you in the form of maybe profits on the real estate or profit from sale or something like that, which we will then pass the depreciation through to you to reduce your basis. And so you will get some form of a depreciation shield for your distributions, but it's more likely in this type of an investment that you'll be paying taxes on those distributions. And you're making income, so you're paying taxes.
Good answer there. Let's talk about passive losses. Does your structure allow for passing through passive losses to investors?
Yeah, it does. And what we do at Caliber is we typically do a variety of tax planning strategies. We'll do a purchase price allocation when we acquire an asset, and then we hire a group that does cost segregation studies, which is essentially combining engineers and accountants to go through a building and figure out what all the parts and pieces are and what can be accelerated in depreciation and what can be moved out of that 39.5-year property and into 5 and 15-year property into personal property. And so we try to accumulate all of that so it's usable when we need it. As we produce income, that we can pass that out to you. Otherwise, kind of Caliber holds those passive or those depreciation losses as the fund sponsor, because we guarantee the debt. And we also then absorb the first round of gains typically. So as an investor, we're trying to maximize your tax strategy internally. We've got an incredible internal tax team, mostly ex-Deloitte guys that do that. And, there's all kinds of fun things you can do in real estate investing. Like they have a thing called ghost depreciation, where it's like you take that board and you say, well, that wall board has 3 years of life left on it, but I'm also going to replace it. So I'm going to immediately expense the 3 years. Then I'm going to replace it with 5-year life property. And then I'm going to expense that. And so don't hold me to any of this because I'm not a CPA, but that's kind of how it works. We get into the details.
Yeah, consult with your accountant again, right?
Yeah.
Let's see. We got an anonymous attendee asks, he or she wants to know, when will the fund start distributing annual dividends?
Yeah, so right now we're setting expectations around 3 years from the day that you invest. We have several assets in the fund that are now producing regular cash flow, and we're using that cash flow to pay fund expenses, and then we'll start to kind of accumulate it and think about producing a distribution reserve, so that when we start producing distributions, they come out to you in more of a predictable formulaic way every quarter. But as most investors, no matter who you're investing with, me or anybody else, you should be thinking, I'm making this investment. It's like a delayed return annuity. 3 years from now, the company will have deployed my money, built a building, gotten it to cash flow, and eventually be able to produce distributions. And anyone who's producing distributions to you right away in this structure is likely just giving you your money back in the form of a distribution, which feels good, but is not necessarily I would say the safest or the most effective way to invest your dollars. So it's kind of like you put it in, you've got to, what do we have to do with it? We've got to go find deals. We've got to build those projects up, and then we can produce cash flow. So that's the structure. We think once we start distributions roughly 3 years from now, we will likely see that they'll remain consistent and grow over time. And the distributions will be coming from both the regular income that we're making as well as some profit sharing as we harvest gains.
Sounds good. Charles has a question for you about your net asset value. He asks, what is the current NAV and how do you justify that NAV considering dislocation in some markets like hotel?
Yeah. We run a global valuation strategy every year, and that's done with using kind of the internal modeling structure that a REIT would use. So you do a discounted cash flow on the business plan for the asset. So, for example, if we have a 10-year development and we're in year 1, and 3 years from now we expect a cash flow, and 10 years from now we expect to sell it, we actually take that entire model, we run it through a DCF process, we use market rate, cap rates, and discount factors. And then all of that is then evaluated by BDO, an outside accounting firm that does a valuation report for us that essentially validates the validity of our model and all the inputs that we use to give a third party opinion on that. And then we roll that into a unit price. And so what that means is, in our first time we've repriced the fund, which was as of 12/31/2020, we were up from $1 to $1.15 a unit, which is the price you would pay now if you invested. We expect to reprice the fund again on September 30th, which is coming up actually very soon. And in that repricing, we had 4 assets at the time, or 4 major projects. 3 of those were still priced at cost, and 1 of those drove the majority of the gain. And to your point, the hotel asset, we actually devalued a bit below cost because of COVID. So we try to keep it fair. We try to make it so that if you've been an early investor and there have been gains in the fund, you're locking those in. And if you're coming in today, you're coming in at a good quality price. I can't give guidance, but I can certainly say that I think that the way that we did the pricing this last round leaves room for upside in the deals.
Sounds good. Quick question from Dane here. He wants to know, excuse me, is Caliber's K1 structure single or multiple K1s for the fund?
It's one K1. We got it out before the first tax reporting deadline this last year. We are highly focused on that. I can't guarantee it will come out on time before the first deadline. So everybody, we always recommend you extend your taxes, and most people who invest in private partnerships do. But having said that, we're very focused on getting out before the first deadline, which, assuming we don't have any more COVID delays, will be April 15th of next year.
Yeah, that's always helpful to get those as soon as you can to the investors. We'll do a final question here, and then we'll break for lunch, and we'll get that breakout session going. Lucy's actually got a few questions here. I'm just going to get to one of them, and Lucy, you should step into the breakout session and ask Chris your other questions for clarification. But quick question for you now, Chris. Lucy asks, I assume the invested money has to be in the fund for 10 plus years. Am I right? And in between, do you distribute any capital gains?
Yeah. So if you want the full tax benefit of the program, you need to be in for 10 plus years. If you have a life emergency and you need to request a redemption, what you're basically doing is you're forfeiting the benefits you could have on a go forward basis. There's actually no tax penalty. So it's not like an IRA structure where you're going to pay this big penalty for pulling your money out early. As long as we can fulfill your redemption request, we will. And then at the time you take the redemption, you then owe those taxes that you've either deferred or that would be due. So that's an important component to keep in mind. And as far as distributions go, what you're doing is you're buying a pool of real estate that we have to build and develop, because part of the program requirement is we have to either build from scratch or buy projects that require significant renovation. So for the first couple of years, you won't see any income distributions. But then after that, those projects start to produce rents. And as the rents come in, we'll start to distribute the rents. And so you'll see distributions of typically rental income coming out of the fund. maybe a little bit of capital gain, but we're going to try to compound those gains and not give you a big capital gain until the end, which is protected from paying any future tax on that gain as long as you hold for 10 years.
Fantastic. Well, Chris, it's time for me and the main session here to break for lunch. We are going to hop into the breakout session for Caliber right now. Again, to join that breakout session, it's going to be in a separate session from this main session. Click on that link in your chat right now. Chris, thanks for joining us, and I'll see you on the other side, man. Take care.
Take care.